Hey, Mike.
Yeah.
You know how you know you're getting old?
Every day that goes past?
Yeah. Also, when you hit the 200th episode of your podcast. And that's what we're doing right now.
Let's
I'm
go.
Matt Robison. That is Mike Morton. This is the 200th episode of 5 Minute Finance, the show where we don't optimize your life. We don't tell you a billion hacks to get yourself to the nth decimal point of perfection. We just let you lighten your load and move on because you've got life to live. You don't want to bother yourself with all this crap. Mike, we don't have one theme. We have sort of 200 themes that are becoming one theme. It's like this bizarre alchemy today. I love the way you've set this up. This is such an awesome show.
Yeah. 200 episodes. It's just, it's ridiculous is actually what it is. I don't know what it's saying.
You know, for my long-suffering wife who actually listens to this, she has begun to tell me that if you listen long enough, you do hear the same story more than once, although she also has to sit through dinner with me. So that might be a factor.
That might be it. That's maybe.
Hopefully for our listeners, they haven't heard the same story over and over again. What they have heard is themes, things that really resonate with them, things that really resonate with us. And what you want to do here is reveal some of that meeting of the minds. Like we want to go inside what this show has taught us about what people really want out of a finance and like how to like get through your day-to-day life and juggle everything kind of show.
Yeah, totally. So we went back in the stats to look at the most downloaded episodes, where the most questions came from, what topics we've covered multiple times that we're getting good feedback from. And so that's what this episode is about. Those areas were tax strategies, the optimization or lack of optimization, keeping things simple, family and legacy, the emotional side of money. So some of the softer stuff as well as the hard-hitting, tactical things. So in today's episode, look, we've done 200 episodes and each of them, varies in length, but they're pretty meaty. They got stuff in there. So today we're going to take the top episodes and top strategies and bang out like the number one thing to pay attention to so that you're getting some really quick hitters in this episode. So stay tuned to each of them because it's going to go by fast.
All right. Yeah. So we're going to go through all of that, what resonated, what questions we answered. You're going to get like an overview of the whole landscape of what we've covered, and stay tuned as if that weren't all enough, because we've got our standard listener question about being confident. I've got a great life lesson about that, by the way. So remind me about that. And we've got our one thing of the week, which is about whether 200 is bad or good. I would say that if you are my height and that is your weight, 200 is bad, but we'll see. And finally, we will do our worth knowing piece about Jonathan the Tortoise. What the hell are you talking about, man? Are you hallucinating?
Tortoise.
Are you Mike GPT?
Yeah, exactly.
All right,
let's get into it, man.
Let's get into it.
All right. Listen, we're going to go through this top 10 downloaded episodes. We're just going to bang them out, and I'm going to give you like the number one tip from each of these episodes.
Is this chronological, or is this most downloaded to least, or what's the order?
There's no particular order, but they are the top okay. 10 episodes. All right. Top 10 episodes. So number one, masterclass, ETF versus mutual funds. So in any of these, you can go back. I'm going to give you the title. So you go back in the feed if you're like, oh, that sounds interesting. The masterclass of ETF versus mutual funds. Okay. There are two different things. You can invest in the total US stock market, low cost index funds, total international stock market. You can do this via a mutual fund. That's what your parents used when they were growing up, or an ETF. And that's the newfangled way of, buying a low cost index fund. And the punchline here is use ETFs, folks, especially in your taxable brokerage account. It's a better mousetrap. There's really no downside to using ETFs. Now, if you want to go into all the mechanics, look back in the feed. But the punchline here is use ETF versions of low-cost index funds.
All right. So that is one of the top 10, not in any particular order. What is the second of your non-order top 10?
It's a non-order. You don't like the non-order.
No, I need order.
It's going to drive you crazy.
I need order. Everything. It's either a right angle or a wrong angle. But go ahead.
After-tax 401k contributions. All right, now there's a lot in just those couple of words.
Okay.
So your 401k, you've got it through work, your workplace retirement plan. Okay, it could be a 403b also. And you can make contributions to it from your paycheck. I contribute 5% of my paycheck or 10% of my paycheck. Now, some 401k plans allow you to make after-tax contributions. So this means it's not pre-tax and it's not Roth. They're actually after-tax contributions. So you can say $10,000 a year or 5% of my paycheck. I want to put in this category of after-tax contributions. What you then do is you roll them to the Roth side of your 401k and you get that tax-free forever money. It is one of the best places to have money. It's the best place to have money. It never gets taxed again. And the bottom line here is this is what you've read about, the mega backdoor Roth strategy. That's what these after-tax 401k contributions are.
Well, speaking of which, I want to get to the third entry here because it is the dirtiest sounding title of all the podcast episode titles you've come up with. Go ahead, lay it on people.
The clean backdoor Roth IRA contributions.
Oh, I'm picturing the Snuggle Bear right now, like the toilet paper mascot. It's like, don't squeeze the Charmin. Tell me more about your clean back door, Mike.
It's very, very clean. So the backdoor Roth IRA contributions, these are, if you are in the lucky place of making too much money to be able to add to your Roth IRA directly, your Roth individual retirement account. So you make more than a couple $100,000 as married couple, then you cannot contribute directly to the Roth IRA. However, you can contribute to your traditional IRA, and that's great because then the money grows tax-free inside your individual retirement account. And you can also transfer money from your traditional IRA, where you just contributed, over to your Roth IRA. And that's great. So now it's growing tax-free, and you pay taxes if you do that transfer. Now, the clean part of this is if you don't have any money in IRAs other than a Roth IRA, then even if you're above the income limit, you can put money directly in your traditional IRA, transfer it across to your Roth IRA, and your tax situation will be no worse off than if you hadn't done anything. So you're going to pay the exact same tax, except that $7,000 or $8,000 is now growing tax-free forever. Again, the best place to have money.
Speaking of Roth IRAs, our next one, number 4 on the countdown here, again, in no particular order. Sorry, that's just sticking in my craw. This one's interesting because it's in the way back machine. This is an episode originally from almost 5 years ago. And it's really appeared to be evergreen. It's very interesting.
Yeah. So we might have to do an update or refresh version of this, Matt. That might be part 2 of this data analysis. Right. So this is Roth IRAs for minors. So a lot of my clients ask me this question all the time that, once we've had this conversation about HSA, Matt knows my favorite account of all time. And we've got Roth IRAs. These are places that money is growing tax free. So every time it doubles, you owe no tax. So it doubles from 7,000 to 14 to 28,000. You don't owe a tax on any of that growth. And so the next questions that my clients ask me is, this is great. Can my kids do this? Like, can I do this for my kids? This sounds awesome. So there is a way you can have Roth IRA for minors. The big catch here is that to contribute to an individual retirement account, you have to have earned income. So your kid is going to have earned income. So depends what level that is. Like you could pay them from household chores and mowing the lawn or picking up sticks or, I would say cleaning their room. Okay. But you get the idea. You could do pretty low level stuff and pay them, but you got to pay them a reasonable wage. So maybe they make a couple $100 in the year. That might not be worth the hassle, but as soon as they have some real income, their first job, maybe you have a family business where you could employ them. All right. As soon as they have some real income, then you can open up a Roth IRA for minors and contribute money in there.
So you did another one with me. This is at the other end of the spectrum, kind of a little bit more recently on traditional versus Roth. I'm not surprised this showed up because we talk about IRAs and Roth IRAs all the time, and you did a heavyweight duel episode.
Yeah, we should probably, revisit this one too, because it's the typical thing. So again, my clients will come to me like, oh, I've been doing the 401k contributions forever, but then there's this Roth and I wasn't sure like which to use. And so then we had the conversation, what is traditional, what is Roth, how they work, and immediately like, wow, that's really cool. Okay, which one's best? Give me the answer. What should I do? And it's a natural question, and it doesn't have a great one-word answer, because it kind of really depends. So traditional 401ks or traditional IRAs means you're paying the tax later. You put the money in, you do not pay tax today on that income. The growth is grows tax deferred inside the traditional account. And when you pull the money out, you're going to pay tax on it. Now, the downside to that is this is kind of the only account that's been around for forever. The Roth ones are a little newer. So I work with many clients that are retiring now that have $2, $3, $4 million all saved up in traditional accounts. And you think, well, when I retire, I'm going to be in like zero income, zero tax bracket, no problem. Well, no, if you got $4 million, you have to start taking that money out to live on. You still are in the same tax bracket. Now, on the flip side, Roth, you put the money in now, you pay tax on it now, but you never pay tax on it again. So when you get to retire, you want to take the money out, it's tax free. Now, the best situation is to have some money in all of these, because the more tools in the toolbox, the better job you can do in the future. Right. So I like to have all the tools. We got some pre-tax, we got some Roth, we got some taxable just in your regular brokerage account. And you can play around with, hey, where should I be taking money from and rebalancing investments, et cetera. So it's good to have all of them. Here's the shorthand version. Pay taxes when your tax rate is low. When you're in your 20s and 30s, maybe early 40s, you're in lower tax brackets, use Roth. Okay. Save in the Roth. If you're in your 40s, 50s, 60s, you're probably in higher tax brackets. Use traditional.
I'm not surprised that this next one was in the top 5% because it's something that resonated with me and actually changed what I do in my life. It was the episode on permission to spend.
Yeah, permission to spend. This is a tricky one, right? And it comes up a lot because typically people are very great savers. I mean, at least a lot of people that I work with are great savers, and they're really good. They got it dialed in. They grew up in a household. It was like, you got to put a little bit away for the future, saving the piggy bank. And then you get your first job and you're putting away. So you're really good at saving money. And the flip side is you might not be as good at like how to spend that money. Now, of course, there's bills that need to get paid. So that's easy. But how do you get over like, hey, am I going to go on this great vacation, or I really should save that money for the future? So how did this episode impact you?
It reminded me, and people can go back and listen to, I hope people will. So I don't remember exactly, I may be repeating something I said in that episode, but it dredged up a conversation we'd had in our household about whether to spend a lot of money to renovate and expand our kitchen. And this is one of the examples of, my wife's always right about everything. And she said, we should do this because we live so much of our lives in the kitchen. And it's a sort of an enabling platform, to sound all like highfalutin, for all kinds of other activities we want to do. And it's changed major events, memorable events in our lives ever since we did it, and our day-to-day lives for the better. And it's the kind of thing where, sure, we could have taken that money and invested it and optimized. And from a pure return standpoint, we might have been better off, but we would have been worse off because we would have underinvested in the enjoyment of our lives.
Yeah. Remember, money is there to be used in your life. It's a resource. It's just like your time. and your energy and your attention are all resources that you have to use and spend to enjoy life now and in the future. Okay. So the research continues to back this up and shows that intentional spending especially on saving time, having experiences, which we talk about a lot, and convenience, all has a stronger impact on happiness than doing additional savings. And what I love about that statement is it's the intentional spending. You have to find things that resonate for you and your family that are the way that you want to use your resources.
Let's talk a little bit about the next one, maximizing employer benefits.
How to maximize employer benefits. I'm not surprised this resonated because employees have a lot of benefits now, like in that package. I mentioned one earlier, the after-tax 401k contributions. There's ESPP that might be in there. There's health benefits and wellness benefits and gym memberships. And there's FSAs and HSAs. I mean, companies are trying to put together a massive package to have employees, retain employees, make it a great workplace. And so you want to make sure that you spend some time going through that packet, right? You get it. And what do people do? They just put it aside, oh, okay, I got this new job, and it's just or the once a year, the open enrollment, you sort of get the package. It's a 15-page PDF, and you're like, I don't have time to go through this. Well, there could be thousands of dollars, of available benefits in there. So I highly recommend looking through there and making sure that you're taking advantage of everything your company has to offer.
Yeah, that was a great, very practical episode from early in the feed. Again, almost 5 years ago, that really just kind of highlighted, here's what to look for, here's how to do it. And that is a good bridge to the next episode on the countdown.
It's the question I get all the time. Oh, I know there's traditional and Roth, and what's the differences? And then it's oh, that's really cool. Which one should I use? Which is better? And so it's just the natural thing. So I'm not surprised it's twice in the feed here. We've already covered it, but I will say on this, it is important. I listen to a lot of podcasts and read a lot of books that have the same concepts, right? And you hear them kind of over and over. And it's reassuring and it's confidence building. And it's good to be reminded, we live busy lives. You're focused on a lot of stuff from kids and family to your job and your career. And so this is not your full-time thing. And so to hear, the constant refrain, I think is really great.
Right. And it's not actually repetitive, even though it obviously smacks of repetition. I mean, this is a lesson I know from earlier in my career when I was managing political campaigns. You need to run an ad at least 15 times before people are even able to kind of recognize the names involved, right? So, of course, the same basic information about something that is a complicated topic is the kind of thing that people want to hear more about, especially when it involves consequential decisions with their money. Speaking of consequential decisions with your money, the next one, all right, look, let's admit it. This next one's a little clickbaity in the title, but it was genuinely useful information.
The top 5 brilliant money hacks. Who came up with that? Brilliant money hacks. That's so good. Here you go, guys. Okay, you can go back and listen to it because they are brilliant money hacks. But here they are. Use your HSA as a retirement account. Choose ETFs over your mutual funds. Maximize those employer benefit accounts and starting your Roth accounts early. All right. And it's funny, Matt, that they all show up exactly like in this top 10 list, that we've been talking about today. Right. So it's funny that those same themes emerge.
Yeah. And, look, for that one, we may or may not have used a headline generator, suggester, website type thing. Just experimented with it. But you know what? The information's still good, whether it's clickbaity or not. Speaking of HSAs, this is an appropriate place to end the countdown with your all-time fave.
Yeah. HSAs, healthy retirement accounts is what they should be, not savings accounts, retirement accounts. The HSA is the only account where you never pay tax. Income tax is the number one bill you will ever pay in your lifetime by orders of magnitude. And the government loves to take a little bit of slice. Anytime you get some money, the government loves to take a little slice. The HSA is the only one you don't pay tax when you make the money. You don't pay tax on any earnings within the account. You don't pay tax when you use it for qualified health expenses, which, trust me, lots of things qualify and you will have health expenses. So HSAs are my favorite account, but the trick here is you have to invest the money inside your HSA. Don't let it sit there in cash. Use it as a retirement account, and it is fantastic.
I want to sum up a little bit here. What are the themes that are coming across all of these top 10 episodes? And was there anything that surprised you being on here or surprised you not being on here?
Nothing surprising being on here. Tax questions, are kind of a core theme throughout here. Being smart with where you're saving, I think, is a core theme. Raw traditional HSAs. Those are very, very typical of the questions I get. I'm a little surprised there wasn't more. We had the permission to spend, but I'm a little bit surprised some of those other topics that we talk about in terms of lifestyle and behavioral finance, haven't shown up as much. But on the flip side, I think we didn't do a lot of that early on.
Yeah.
And I'm getting good feedback on it now. So I wouldn't be surprised to do this for our 300th episode, that a lot of those themes come up.
In case we live that long, that's a good point. It is very much our intent to revisit all of these themes up ahead, perhaps with a slightly different cut at it that may work better or take a new, interesting, fresh angle on the same basic set of questions. So just keep subscribing and listening. All right. Anything else to cover before we move on?
No, 200 episodes, man. It's incredible. Glad to be here and looking forward to the next, just a few. Let's start there.
All right. Yeah, that sounds good. Well, I mean, the best part of it is truly, I really mean this. There's a lot that you pick up on that is in these episodes that is essentially the same way we talk to each other when we're just hanging out, right? Like, all the digressions, all the conversations, the one thing, the listener, I mean, we talk a lot less shop. We don't talk finance when we're hanging out, but all the digressions and the problems that we're dealing with juggling in our lives, you're getting the stuff that we talk about all the time. Speaking of which, let's get to our listener question. This is our listener question, which, of course, if you're a client of Mike's, you can just call him and ask him yourself. If not, just email us. Morton, what is it? What's the email again?
Pod at mortonfa.com.
At mortonfa.com. I'll get that by the 300th. The question this week is, at what point can we stop worrying about whether we're missing something and just feel confident in our plan? Never.
Yeah. Never.
Keep worrying.
Well, it's interesting, in this context of the 200th episode, it reminds me of what we just said before, that, being human, you'll get to, your emotions just keep swaying, from one to the other. And I listen to lots of podcasts that repeat the same thing. And when I'm listening to the podcast, I'm like, oh yeah, I remember I got to do that. Whether it's like journaling or meditation or workouts or whatever, like you're just kind of reminded, oh yeah, this is good for me. Like I got to go, do this thing. And then you sort of forget, in between the episodes, you don't go back to that author for a while and you're like, oh, I'm feeling like I'm not keeping up with my thing. My workouts are kind of tailing off, or my nutrition or whatever it is. And then you go back, read a book or something, like, oh yeah, I'm going to get back on that. And I feel like finance is kind of the same. Like, oh, I'm feeling really good. I'm feeling good about my plan. I remember we have a plan. I'm saving here. I check the investments. They're all good. And then you're feeling great for a while. And then a few months later, you're like, oh, I was reading the news. The market's really kind of changed or something happened. I wonder if we're okay. And you start feeling a little more worried again. And then you have to go back and revisit or listen to the podcast or the book or, kind of review your own situation to remind yourself, like maybe there's a tweak to make, maybe there isn't, but just to feel good again. So I do feel like this question is more about, do you have a way to constantly update and refresh and revisit your plan that builds that confidence throughout the year?
I have an answer that I think is very similar to yours, in that it depends a little bit on kind of what version of the question you're asking. What's the prompt that's making you think, should I worry or not? If what's prompting you is, do I have the right overall approach? I would say that the answer is basically never. I think the whole purpose of your work in this show is to get people to a point where they feel confident in their overall approach and not worry about this, like, oh, I didn't optimize this shit. And it's that feeling of something hanging over you of like, oh, I know there was this hack and I could have made $200 more this year. Damn it. I forgot to do it. I'll put it on my to-do list. We're trying to accomplish the opposite of that. All right.
Sounds good.
Well, with that, let's get to our one thing. All right. So this is our 200th episode. What do you have for us for our 200th? This might not be quite our 200th one thing. We started it a little ways in the run. Right. What do you have?
200 episodes. So the question is 200 of what makes you feel good or makes you feel bad. So, and it's all about framing. So it's very interesting. Like just the pure number 200 is neither good nor bad. It's just a mathematical number. So 200 that you spend going out with friends on a nice dinner, like that feels great. Hey, I spent $200, but $200 spent on a surprise bill for your plumbing. Yeah, maybe it doesn't feel so good. So that's what 200 of what, Matt, makes you feel awesome?
There's literally no amount. I'm actually I could make a joke here, but I'm going to treat it seriously. I took a trip with my daughter yesterday, like a day trip, and, she was playing basketball and, that kind of thing. I could do a million of those. There is no amount of that wouldn't, I'm not going to use a double negative. Don't use no double negatives. There's no amount of that would begin to set diminishing marginal returns in. But I will say, to your point about a $200 check, I think there's a bit of the Joker principle of if something happens and it's according to plan, we feel like it's fine, it's normal. If it's not according to plan, then it feels bad.
The anchoring principle is real here. Yes. And it came up for me, the anchoring principle that, here we go off topic, but in terms of behavioral finance and anchoring college costs, you get this number in your head, like, oh, here's what I think college is going to cost us, say $50,000 a year. Okay, just to throw out a number, I think we can sort of afford, or that's what I'm thinking we're going to pay for college. And then your kid goes to something that's $30,000 a year. You're like, man, this is awesome. This is great. Wait a minute. That's still, I'm going to spend $120,000 and I'm feeling really great about it. Yeah. It's all based on that anchoring. Let's move on.
All right. Here is what is worth knowing. This is from you. I did not look ahead at this one, so I have no idea what's coming.
There is a tortoise named Jonathan who lives on the tiny island of St. Helena. And this tortoise, Jonathan, is nearly 200 years old. Almost as old as the number of episodes that we've done. And you might remember St. Helena from your history lessons, because this is where Napoleon Bonaparte was exiled in 1821, which was just 11 years before Jonathan was born.
Wow. Wow. That is something. So what you're saying is there is a lesson in Jonathan.
You know that the moral of the tortoise. What is the moral of the tortoise who's almost 200, Matt?
The soup I can make from your carcass is delicious.
Or it might be a little gamey.
There are two kinds of animals in the world, dangerous and delicious. The tortoise is not dangerous.
It depends which end you're at. I don't know. Snapping tortoise?
Oh my gosh. This is like your clean backdoor Roths. I'm very disturbed by what you're
slow and steady, Matt. Slow and steady.
Yes.
Slow and steady. Tune in every other week to get your slow and steady episodes of 5 Minute Finance, and you too will live a long time and be happy.
That is as great an ending note as we could possibly come up with for 200. And it's ending, and it's not, because we have more coming up. So stay subscribed in the feed. It's been a pleasure doing these with you, Mike, and looking forward to doing a lot more. All right. For Mike, I'm Matt. We'll see you next time.
Thanks, Matt. Thanks for joining us on 5 Minute Finance. If you like what you heard, please subscribe to and rate the podcast. It makes a huge difference for my show. You want more? Find Morton FA on Substack. If you have a comment or question, please email pod@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.